Welcome to today's live episode of Understanding Edge, where we explore the trends, challenges, and opportunities shaping the fixed income markets. My name is Douglas Gimple, and I am the Senior Fixed Income Specialist here at Diamond Hill. I've taken back the reins of this podcast from our current host, Jessica Schmidt, for this one episode so I can bring in Portfolio Manager Arthur Cheng and ask him some questions about his background, his approach to the high yield markets, and the current environment in which we find ourselves. While I could walk listeners through Arthur's background, I thought it'd be more beneficial to hear directly from him. And we'll get into that in just a second. But first, I've got some instructions for our listeners on how to submit a question once Arthur and I have wrapped up. To submit a question, please use the question box that appears in the lower left part of your screen. We will try to answer as many questions as possible, but if your question is not fully answered, please reach out to your Diamond Hill representative. We will also publish this episode of Understanding Edge on our website or wherever you get your podcasts from. I would like to remind listeners that this call is being recorded and all opinions expressed are those of the speaker as of today and are subject to change without notice. Without further ado, let's get into the discussion. So Arthur, first and foremost, welcome to the podcast.
Glad to be here. Thanks for having me.
I've known you for quite a while, having worked with you back in the JP Morgan days here in Columbus when you were an analyst on the client portfolio management team. Let's get started with a quick recap of your background, ranging from your time at UCLA, now a Big Ten school, to JP Morgan, to Post Advisory, to Diamond Hill's fixed income team.
Yeah, so I joined the client portfolio management team at JP right after graduating from UCLA. I sat right next to Henry, Mark, and you, and we were all about within 10 feet of each other. I knew pretty early on that I wanted to be on the investment research side of things. And transitioned over, shortly thereafter, became a research analyst for the high yield team, which is where I spent the majority of my time at JP. In 2017, I left JP to join Post Advisory as a research analyst as well. Post is another large high yield and leveraged loan asset manager. I learned a lot there, especially, as it pertains to the intricacies of the short duration part of the market and managing CLOs. I think I left for Post around the same time that you, Henry, and Mark came to Diamond Hill. We kept in touch, or I kept in touch with you and Henry, and I was aware of the strong track record that you all had put together here on the IG side of things. Over time, we talked about how Core Plus seemed like a logical place for Diamond Hill to expand into, and our investment philosophies matched up well. Luckily, everything worked out.
Yeah, and you joined Diamond Hill specifically to work on the new Core Plus strategy, which started last year, and you're focusing on a high yield allocation that's combined with the allocations from our core bond strategy. So how have you focused on building out that plus allocation since the strategy launched in mid-October of last year?
When the strategy launched, high yield spreads were at all-time tights, and U.S. equity market valuations were in the upper end of history as well. High yield had an option-adjusted spread, or OAS, of 285 basis points, and the 10-year average leading up to that point was around 420. There were good reasons for the tighter spread. The duration was at an all-time low since most companies took advantage of the low rate period coming out of COVID to refinance and push out maturities. In addition to that, the credit quality of the index has been rising as double Bs have become a larger and larger percentage of the overall market. But all that said, spreads were still very tight relative to history, and the multiples of other risk assets were also on the high end of history. And we felt it was prudent to stay higher quality, which meant having minimal exposure to triple Cs, the riskiest part of the market. And so with that in mind, from there, it's just a matter of filtering the universe down and finding ideas with compelling risk reward. A natural starting point for me was introducing myself to all the equity analysts and looking through the high conviction parts of the equity portfolios and seeing which of those had high yield bonds.
So Arthur, the high yield market it's pretty large, right? I mean, it's about 1.3 trillion. There are nearly 2,000 issues. How do you work through the market to find opportunities and identify potential risks, and what kind of resources are available to you?
Ultimately, we don't need to have an opinion on every single bond in the high yield universe. We're just looking for enough high conviction ideas to make a portfolio with a strong risk-adjusted return. So I like to start by splitting up the market into different buckets of opportunity. It takes a lot of time sometimes to fully underwrite a company and a security, but oftentimes it can be much easier to identify whether a bond has the potential to be interesting and then add it to a list to be fully diligenced out later. For example, a little over 10% of the high yield universe is made up of names with spreads 150 basis points or tighter. And then there are portions of the universe that have very short maturities where upside is limited or aren't buyable at attractive yields. These bonds can be safe, but outside of an imminent market collapse, a lot of these bonds will have a hard time outperforming. Now, on the other end of the spectrum, you've got 5% of the universe that is distressed with spreads greater than 1,000. And we can own this stuff, and at times there can be opportunity there, but that's typically not where I'm concentrating most of my time in the context of our Core Plus portfolio, where we're really focused more on performing credit. Now, and then on the behavioral aspect of, side of things that I like to layer on, I think through, are there features to this security or company that make it more likely to be mispriced relative to the risk? And this can be any number of factors. Maybe the sector is currently out of favor. Maybe there's low sell side analyst coverage. Private versus public. With private names, there's just less available data. Or maybe there can be features of the bond that are atypical. Maybe it's not a fixed coupon. The maturity could be outside of the typical high yield range. So, all this to say, if you have a very large bond that's owned by all the passive ETFs, covered by a lot of the equity and fixed income analysts, it's likely not the best place to find a mispriced security. That's not to say we won't take a look at it, but it's just lower priority. So the key for me is to try to quickly narrow down the larger universe into a smaller number of more manageable groups. And from there, get deeper on specific names. Once I have a list of these bonds that can be interesting, then I can go through the fundamentals of each issuer. About 2/3 of the high yield universe has publicly traded equity. We're lucky enough here to have around 20 equity analysts covering everything from micro cap to large cap. So I'm able to have quick conversations with each of them to quickly triage the industries and specific names. And maybe a couple of examples will be instructive. Bank OZK is a regional bank. They had a bond outstanding that looked like it could be undervalued. I saw that we owned the equity, and I was able to quickly call up the banking analyst who was able to talk in great depth on all aspects of the business and the industry. He had done a comprehensive study that examined how 150 different banks had compounded intrinsic value over the last 50 years. And, another is Concrete Pumping Holdings was a new issue to the high yield market. I did enough work on my own to see that it could be interesting, but then saw that this was a high conviction idea in our microcap equity strategy as well. So it's not uncommon that I come across an idea and I'm able to speak to an equity analyst or a portfolio manager that has a long history with management to the point where they recognize us as a large equity holder when I first introduced myself to the company. I'd say even for bonds of private companies, which is the remaining 1/3 of the universe, they often compete with a public company. So I can quickly get a rundown on the main issues impacting the industry, what a top performer looks like, who the weaker competitors are, and it allows me to quickly place the private company within the competitive landscape of the broader industry.
So, Arthur, let's talk current markets. So since Liberation Day, April 2nd, it's been pretty much nothing but volatility and uncertainty, not only in the fixed income markets, but the financial markets overall. What have you been seeing in the high yield markets, and are you actively taking advantage of some of the dislocations that have hit the markets recently?
As I had said before, the high yield spreads leading up to the tariff announcements were at historically tight levels. And then spreads had widened leading up to that point, but then gapped up significantly after Liberation Day. hitting a peak of 450 basis points. The names that were most impacted were all the tariff names: retail, autos, energy. I'd say that the biggest surprise to the market was the very high tariffs on the Asian and Southeast Asian countries outside of China, such as Vietnam and Cambodia. A lot of these companies, especially the consumer products and retail companies, had shifted production outside of China over time as they became areas of lower cost production versus China, as well as in response to tariffs on Chinese goods put in place during President Trump's first administration. As far as our positioning, we de-risked a bit ahead of Liberation Day, particularly in riskier or industries that were likely to see tariff impacts. And then we used the volatility to add to certain high conviction, higher quality names. So an example is Adient, a company that manufactures seats that go into cars. We sold longer Adient unsecured bonds the week prior to Liberation Day, and then we re-entered the credit by purchasing shorter maturity secured notes afterwards. So we effectively went from the longest bond at the bottom of the capital structure, which is the riskiest security, to the earliest maturity at the secured level, which is the safest part. And we were able to do this swap separated by a couple weeks, essentially at an even yield and spread. So in this particular case, we were able to keep return mostly constant while decreasing risk. Similarly, within retail, we sold off direct retail exposure before the tariff announcements, and then afterwards added to tangential industries. One that comes to mind is Bread Financial, which offers private label store branded credit cards. And this was a name that had gotten caught up in the retail sell-off, but has a strong balance sheet with substantial credit card receivables supporting the bonds. Now we found ourselves in a place where high yield has since rallied since the immediate sell-off, and spreads have tightened from the 450 to mid 300s level. Still wider than where we started the year, but back to levels tighter than historical averages. The tariff impacted names, remain wider than the broader market, but a lot of the non-tariff names are, basically back to pre-tariff levels.
All right, Arthur. So let's shift to the audience to see if there are any questions out there. Audience, please utilize the question box that is in the lower left-hand corner of your screen, I believe. We already have one in. So Arthur, I will ask you, and we'll wait to see if others come in. So on the Core Plus strategy, how do the PMs work together to determine the sector allocations within the portfolio?
So I oversee the high yield piece of it, Henry the securitized piece, and then Mark IG corporates. All three of us sit next to each other in the office, and we talk about what we're seeing every day in each of our respective areas. We'll talk about everything from sector level spreads versus historical averages to comparing the risk and reward on a security level, of say a triple B ABS security and how it compares to a double B in the high yield market versus a triple B in the IG corporate market. From these conversations, it's usually not too difficult to reach a consensus as to where the most attractive incremental opportunity is and how we should be moving the portfolio.
All right, so one more question it looks like, and then you're off the hook for your first podcast. In periods of market dislocation and opportunity, how much can you allocate to the high yield markets within the Core Plus portfolio?
So we like to think about high yield as in a typical market environment being 8 to 12% of the overall portfolio. And we can dial that up or down depending on how attractive high yield spreads are and depending on the amount of good ideas good ideas that we can source. And so, we think about it incrementally as dialing up the high yield allocation as the opportunities are there and as the spreads widen. So if spreads widen to, for example, the 500 level, you could see that 8 to 12% creep up, and then, even more to potentially make up maybe 15 to 20% of the overall portfolio as spreads widen even further. But it all depends on what we're seeing in the other sectors as well. I mean, it could be the case that whatever causes high yield to widen affects the securitized piece of the market at the same time. In which case, we could allocate capital to both rather than just one or the other. So it's a fluid situation, and we sort of just respond to whatever the market gives us.
All right. Well, Arthur, thank you so much for joining. We're going to go ahead and wrap up today's call. We really appreciate your partnership, and we'll continue to look for ways to keep the lines of communication open between our investment team and our clients. If you want to hear more of our thoughts and continue to stay up to date on market information, I would direct you to www.diamond-hill.com. Once again, we appreciate your participation and wish everyone nothing but the best.